quickly just introduce yourselves with name, protocol, and maybe one sentence about the protocol.
Hey, I'm McDavid. I'm the head of growth at Aperture Finance, and we're using intents to help LPs on Uniswap v3.
Hi, my name is Chunda. I'm one of the founders of Ion Protocol. We're a lending platform specializing in the support of staked and restaked assets.
My name is Warren Paul Anderson, co-founder of Exocore. It's an L1 omni-chain restaking protocol.
Hey, I'm Dominic. I'm the head of ecosystem at Li.Fi. We are an interoperability middle layer, and we aggregate purchase taxes, tax aggregators, and solvers.
Awesome. So I want to dive into some restaking and intent stuff eventually, but I'm going to start with a question that's common to everyone here. You're all pre-token launch teams. How are you guys thinking about points programs? How do you bring in liquidity that sticks around? How do you deal with competitors doing very aggressive airdrops in the future, seemingly? Just want to get a sense how you guys are thinking about this stuff.
Yeah, I can start it off. So for Aperture, we initially were kind of like hesitant on the whole point scheme. We're definitely a late adopter. We're currently building out our points program, but for us, it seemed like something that we had to do to play ball with like listings on centralized exchanges. Basically, you need to get DAU numbers up. You need to have transaction volume go up, all these kinds of metrics just to make things as like hyped and pumped as possible. And of course, if you want mindshare in this current environment where basically like 2 years ago, all the people I met in crypto were trying to just find like yield and all these different pools. And now that whole like cohort of DeFi users is basically just migrated to like aggressive airdrop farming. And so this is the user base we have on chain right now. And you kind of have to play ball with them. And a point system, I think, is the most friendly way for a protocol to engage that user base. I think obviously the biggest advantage of points is that if something's not working 1 week, you can quickly pivot and adjust and assign a different amount of points. You can launch a new feature that you assign more points to. There's a lot more flexibility that can kind of help you iterate and learn faster and hopefully ultimately do something that gives you the most amount of marketing bang for the ultimate amount of like tokens you have to airdrop to those users.
Yeah, I'd say like along those lines, I generally think of point systems as really it's just a different packaging of the pre-existing liquidity mining that has existed since the beginning of DeFi, or more specifically Compound back during DeFi summer. I think realistically, it's something that most every protocol is doing simply to defer like their token generation event in order to defer like market valuation of the underlying like asset. I think it's a tool that you can leverage to incentivize certain user behavior. The way I like to think about point systems internally at Ion is thinking about, okay, if you're building a base layer primitive that you think will have utility and will have or values in the future, what are the like largest points of friction in that protocol, and where can you effectively like use grease to like smooth the gears to allow users to more easily recognize and convert users that might be at first chasing like initially high upside, find ways to allow them to realize the value proposition of the protocol. And then if you emphasize composability as one of the core functions of the protocol, you can then ideally expand that usage and integration into the protocol of a user into utilization of other protocols and more sticky liquidity in your protocol. I kind of think of it as kind of a user acquisition opportunity that you then just have to kind of hammer down the core value proposition of the product. And if you don't have a value proposition, then I think the liquidity leaves.
Yeah, for the most part, agree. But it's basically like a really effective tool to quantitatively monitor and track community engagement and growth, which I think is actually good. It helps teams really kind of get a sense for what's going, especially it's on chain. The off-chain point systems, I think, you have to be careful because they can be gamed. Any of these schemes, if it's gameable system, it's obviously not a good design. On that side too, like keeping things simple, I think in crypto we have a tendency to take simple ideas and make them way more complex than they need to be. And then in that complexity, something emerges where people get hurt, they lose money, et cetera, et cetera. So I think the goal for the space is just to make sure to keep things simple and use them to the advantage of actually tracking community engagement and growth.
Yeah, I mostly agree. I think point systems are like at the end of the day just an attention game. You can garner attention with them. If your product is good, they will attract users to your product, and these users will become long-term users of your product. But on the other side, they also kind of make that more difficult for the team to see, right? We all know that once you have a token, it's kind of harder to know if you have actually product market fit or if you just have like short-term token fit. I think specifically in the market like environment that we see right now, there's a lot of protocols like that. And the point systems do that already pre-token because that's what the user perceives them as, right? As a pre-token. So yeah, I think there's a lot to be said. And for example, we have Jumper, which we had a point system like pretty early on. And it definitely helped us like grow the platform to where it is today. But it also makes it harder for us to differentiate a real user from a farmer, right?
Yeah, I'd say the one thing that's actually really interesting about point systems is like, when you really think about it, it's not new. Point systems exist in backends, really, realistically, right? When we do airdrops, they're just point systems, right? It's just now users can see it. And so you kind of get this interesting dynamic where it actually democratizes the access to hype building in a certain context, because before, hype building could only be done with large rounds, valuations, that kind of stuff. Now you can kind of a little more organically build hype just with point systems, which realistically was what people were speculating on pre-visible point systems with more opaque token airdrop campaigns.
Yeah, got it. I want to switch to maybe a more restaking specific question. So the story of liquid staking over the last 2-3 years has largely been Lido kind of growing and expanding its market dominance, with restaking at least attracting a ton of liquidity. I'm curious, particularly for Exocore and Iron, how you guys think about the liquid restaking opportunity and whether this feels like a moment to finally unseat Lido or not really.
Yeah, I mean, I think it does. Like the LRTs kind of came on the market fast. I mean, even for crypto, it's pretty fast. And I think it's taken over a lot of the narratives. And I think from a value accrual model, it can be more attractive than standard LSTs. And so there's an opportunity to really diversify the asset classes as long as we're not repurposing the same problems. If all the LRTs are being pulled into different like SEETH or something like that, then we just kind of perpetuated the problem and made it worse. I think there's some really cool, innovative solutions to this. For instance, like Puffer did a campaign where they're attracting yield to effectively restake it into native ETH. That is a good solution and like very concrete. We need to keep doing that. But I should say, let's not like recreate the problem again in restaking. This may be a hot take, but the restaking market is currently dominated by one player, and that's Eigenlayer. So Exocore is an alternative to Eigenlayer. We're kind of approaching the restaking from a fundamentally different design. And we think it's healthy for the market to have more diversity in these markets. So we're not sitting up here a year from now asking the same question and just inserting Eigenlayer as the question being the monopoly in restaking. So I think let's not recreate kind of the same problems and perpetuate them year after year.
Yeah, I think from my perspective, I do think that generally it's an easy incentive to unseat Lido with the kind of potential reward upside for that LRTs provide, especially with points campaigns and the things you've mentioned, like we were just talking about. I think the interesting thing here is through interactions that I've seen, like Lido seems to be focusing on distribution just directly through native restaking. I think the question we should be asking ourselves is, if the market share of LRTs grows to a significant enough value to threaten Lido dominance, what does having a pre-existing liquid staking provider of that size entering to the restaking ecosystem? Because I think realistically, I find it difficult to believe that Lido will let their market share evaporate. And I think you could have really interesting second order effects where if we do have enough traction to start threatening the position of Lido, that they reposition themselves to also be a player in the race. And I think thinking about the implications of that and how do we ensure that we still have kind of a well-decentralized restaking landscape, even if we have a really large incumbent enter into the ecosystem, are things that all the kind of stakeholders in the restaking ecosystem should be thinking really hard about.
Got it, yeah. I agree with that view on Lido more generally as well. Switching tracks, I want to chat a little bit about intents as well. And more generally, on the intent side, it feels like with things like Uniswap X, we are increasingly entering at least some parts of DeFi where you kind of have a user express a preference and then have solvers bring in liquidity on-chain, off-chain, or from wherever they want to solve it. And all we're doing on-chain is really just verifying that the intent was satisfied. I'm curious in this world for a market dynamic, how you guys think about, like particularly Li.Fi as an aggregator, or you guys, how you think about attracting flow and how important it is to be, like, do you want to be the actor in the front end? Do you want to be the person sitting on top of a large solver network? Like, where do you think flow, like where do you think market value shifts if we do bridging or like LP management only through intents?
Yeah, I think generally you said the right thing, right? At the end of the day, this liquidity game is about order flow, right? Whoever has the order flow, they can route to solvers, to aggregators, whatever. At the end of the day, it doesn't really matter. If you don't have order flow, you can build the most beautiful engineering system and still you're gonna get close to no traction or volume, right? And obviously we do our own user interface jumper, but then also we power a lot of the B2B integrations of wallets. But even there we see, like, for example, with some of the bigger wallets where currently they're getting the liquidity routed through our smart contract, that might also be something where they thinking about how can they own that order flow, right? I don't think it's going to be as easy as like us having all these B2B integrations and then being able to like monetize that order flow to like solver networks or MEV or whatever, because obviously these actors also know that their order flow is valuable. So yeah, but from my perspective in the system, or at least from our perspective, we want to sit as close to the user as possible.
Our general take with intents is that they're ultimately in service of the end user. And doing this like along this path, like if Uniswap X, at the solvers at the top of that flow end up taking a lot of the swaps and winning those swaps, they're going to steal yield from like the underlying LP. That probably could cause some like disruption within the ecosystem. But ultimately at the end of the day, we're trying to make swapping on chain better than it is on a centralized exchange or get as competitive as possible. And I think everything we're doing as service of that is ultimately better for the ecosystem as a whole, regardless of where the chips end up falling with like the underlying LPs on UniV3 or UniV4.
Got it. And maybe that segues into another question I have for all of you, which is that we've been excited about DeFi for a long time, but in a lot of spaces, like perpdexes are a good example where we've had Binance have a settlement, FTX collapse, Bybit enforcing KYC, but perpdex volume is still like 1 to 2% of Binance volume broadly. On spot trading, it's a little better. But broadly, I'm curious, like what's kind of a catalyst that each of you are excited about to actually bring a lot more liquidity on chain? Like, what do you think is next in terms of pushing people off centralized platforms? Because it feels like we've had a lot of forces push over the last year, and the actual volume that has shifted from off-chain platforms to on-chain platforms is actually kind of disappointing.
Yeah, I'd say like from my perspective, like one of the biggest kind of bottlenecks one of the biggest bottlenecks in general when it comes to like off-chain kind of primitive design versus on-chain is just execution speed and so on and so forth. And the problem is, okay, well, if you want to facilitate faster execution speed, you need to build custom execution environments. And then the problem with that is you have liquidity fragmentation, right? Now, I know there's a lot of discourse around the feasibility of shared sequencer opt-in from rollups, but I think realistically, some kind of a coalition or the beginnings of building coalitions between rollup environments in order to decrease the fragmentation of liquidity between like faster throughput execution environments and aggregating like base layer liquidity between rollups is going to be really the only way I can imagine that we could build decentralized options that could compete at least close to at par with off-chain solutions. So hopefully we can get some rollups to cooperate and collaborate and build those coalitions.
Yeah, I think over the next 18 months, we're going to see probably DEXs overtake centralized exchanges in terms of volume, and not just like in a moment, but sustained. And I think it's going to come from some of like, I love watching the innovation that comes out of Uniswap, and like their latest proposal, the fee kind of distribution is super innovative. It's like in the TradFi world, like imagine being able to own like the ICE, which is the Intercontinental Exchange like token, and you get access to lower trading fees and just benefits as a market maker, but then also participating potentially in like the profits of that exchange. I think is like, that's incredibly interesting. And it may be just as simple as like people just want to make more money and they're going to trade on the venues where they can make more money in every way, where trade on Coinbase or any of these centralized exchanges, you're not making, unless you're long on their stock or something, you're not making any money on the actual underlying, right? So there's going to be more innovations that happen. I think Uniswap is definitely leading the way, but yeah, watch it happen.
I think we also need to think about like what actually needs to be on chain, right? If we look at something like CowSwap, the order book and the order matching doesn't actually happen on chain, right? The trades happen on chain, the settlement happens on chain. Every intent system that everybody's talking about here has something like an intent pool, like a gossiping network where the intents actually match each other. None of that happens on chain. The actual settlement of the trades happens on chain. And that's the only thing we really want, right? Because we want those assurances when we do these trades. There's other technology, obviously, in terms of like use kind of like programmable trust to get better systems here. So if the question just is like centralized exchanges in terms of like custodial centralized exchanges, I think over time, nobody will do that anymore because nobody really wants to have their money like locked up in a centralized exchange. They still do it, the bigger traders still do it because they don't really have an alternative in terms of liquidity yet. But once these alternatives become better, the liquidity will move to other venues.
Got it. I want to switch tracks again and chat a little more about like an observation that a lot of us who invest in crypto have had is that there's like an L1, L2 premium where for whatever reason, infrastructure in crypto tends to trade at way higher valuations than very often DeFi applications do in particular, but lots of just like things like Aave and Maker that have a ton of product market fit often trade at far lower valuations than your L2 flavor of the month that has like no liquidity. So I'm curious, as developers of things that look a little closer to applications than to L1s, L2s, how you guys think about that and how that affects when you're raising, how you think about valuations in the space generally for applications.
I can take this one. So at Aperture, we've kind of seen two forces pushing us into this sort of like more application layer space. The first is that the stark reality of like market valuations, right? Like they're definitely better on the infrastructure side of things. But secondly, like we have some like intent-based solutions for LPs on UniV3 currently. And the user feedback we get from this like initial cohort of users, we have about 3,000 active wallets. The feedback we get from these users is that they want way more automation solutions than what we could possibly build if we just went like smart contract by smart contract to do some like specific execution for them. So that insight alone has pushed us to like, we just released a light paper this week talking about a more generalized intent-based architecture that we would launch that would help enable a lot more of these use cases that we would never be able to build if we just took this like smart contract by smart contract approach. So yeah, we definitely feel that at Aperture, but we've also seen just based on what DeFi users want that there's some infrastructure needs that have to be settled first before we can actually satisfy everything they want.
Yeah, so the way I look at it, one, very true. I think the core of why that dichotomy exists is about the ability to kind of speculate on the future value capture, which I think for rollups is that there's hot contentious debate about whether or not sequencer revenue is a sustainable revenue model in the long run, or whether or not native MEV capture for rollups will also be efficacious. But I think that ability to basically ponder on the future value capture of a network is what drives that large premium. Whereas when you build a DeFi product, right, it's very easy to kind of map out exactly what your fee structures could look like, where you capture value, and then, well, now you just take a look at revenue multiples and you get a valuation, right? So I think the way that kind of we at Ion like to approach kind of thinking about building DeFi primitives is trying to get creative about how large the customer demographic and what kinds of customer demographics you can actually target with your underlying primitive. And so for us in building Ion, which is effectively like a price agnostic platform lending against staked and restaked assets, we actually have basically built the first DeFi protocol that has zero exposure to exogenous market volatility. And there are a lot of very interesting markets that you can capture. So I think being creative around kind of what kind of customer demographics you can target and where exactly can you fit yourself into the composability of all the pre-existing DeFi primitives.
Yeah, I'm kind of old school when it comes to like, I'm a big believer in the FAT protocol thesis at U Square Ventures. It was like 2016. After I read that, it was like game on, like L1s are going to continue to march forward. There's a great value accrual model. We actually had to make very early on a design trade-off, whether we implement restaking at the like potentially L2 or implement a smart contract based system like Eigenlayer or build an L1. And we actually went with the L1 for the biggest reason was actually decentralized governance and being able to make sure that we're not beholden to a governance via multi-sig model. And we feel like that's an interesting kind of trade-off when it comes to these things because the value accrual will eventually go back to the holders of any token or the operators of the network.
You want to wrap up? We have like a minute left.
I think there's mostly like two arguments that speak for the like increased value capture or like the moneyness of layer 1 or layer 2 tokens, which is just basically like owning your own stack, and on the other hand also the ability to capture your own MEV on your own chain, which is like, if you look at some of these DeFi protocols, right, like Frax is a good example actually right now with building Fraxtel. I talked to Sam yesterday and that they want to kind of use that as a hub chain because it makes sense for them, right? They have a lot of firepower to their curve holdings, and it allows them to capture a lot of their own MEV on their own chain. And then you have also the kind of like using the token of the chain as an intermediary asset, which happens on a lot of chains. So that makes those tokens more money-like. And so I understand why there's a certain premium to these assets, but obviously for the majority of these tokens, that's probably a little overblown right now.
Nice. Okay, I think we're at time. Thank you, guys.
Thank you.
Yeah.